Hello everyone, welcome to Big Players.
In this video, I am going to be revealing a very simple yet powerful strategy that can help you generate consistent profits. I will be sharing all the aspects of the strategy step by step, so please do not skip any part. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. So first, let us understand the fundamentals behind the strategy. This strategy is a trend-following strategy. Hence, we will be looking for buying opportunities in an uptrend and selling opportunities in a downtrend. We will be focusing on the assets that are in a strong trend only. In this strategy, we will do three things. Number 1, identify the trend. Number 2, wait for a pullback. And number 3, enter when the market resumes the trend. To accomplish these steps, we will use two moving averages. Moving average is a simple indicator that plots the average price of an asset over a certain number of candles. For instance, a 10-period moving average will give the average price of an asset over the last 10 candles. When the price is above the moving average, and the moving average is sloped upwards, the price is considered to be in an uptrend. Similarly, when the price is below the moving average and the moving average is sloped downwards, the price is said to be in a downtrend. And when the price is moving around the moving average, and the moving average is flat, the asset will be considered to be in a sideways range. In our strategy, we will use two exponential moving averages. We will use a 20-period EMA and a 50-period EMA. The 20-period EMA is blue, and the 50-period EMA will be yellow. This is the only indicator that we will use in our strategy. Now, you can use any time frame that you want. I recommend using a 15-minute chart or a 30-minute chart. Anything above the 30-minute chart is good. But just don't go below the 15-minute time frame. Once you get really good with this strategy, you can use a lower time frame. But until then, stay with the 15-minute chart. For this video, we will stick to the 15-minute chart. So now, let's look at the strategy itself. Let us start with the steps for entering long. The first step is to identify the trend. We will use the moving averages to identify the trend. So, for an uptrend, the price should be trading above the 20 and the 50 EMA. The 20 EMA should be above the 50 EMA. And both of these moving averages should be sloped upwards. When all of these conditions are met, we can conclude that the price is in an uptrend. Hence, we will be looking for long trades only. The second step is to wait for a pullback. Now, we want the price to make a small pullback. The pullback should at least touch the 20 EMA. It is not mandatory for the price to close inside the 20 EMA. Even if the wick of the candle touches the 20 EMA, our setup will be valid. Now, a big question is that what if the pullback turns into a reversal? What if the price touches the 20 EMA and never comes back? How do we know that it is a pullback and not a reversal? The answer to that is the 50 EMA. When the pullback occurs, we want the pullback to touch the 20 EMA, but it cannot cross the 50 EMA. Once the price crosses the 50 EMA, our setup will be invalid. Hence, we want the pullback to stay above the 50 EMA. Now, the third step is to wait for the price to make a new high. After identifying the pullback, we want the price to resume the existing uptrend. A solid evidence of the trend continuation occurs when the price breaks the most recent swing high and creates a new high. When we see a candle close above the most recent swing high, then that candle becomes our entry candle. We will enter on that candle. The fourth and the last step is to place stop loss and targets. We will place our stop loss at below the 20 EMA. And we can place our targets at 1.5:1 risk to reward ratio. If our entry is far away from the 20 EMA, then our stop loss will become a lot wider. In such cases, the best thing to do is avoid that trade. Let us look at an example to understand the strategy. Here we have the USD-JPY pair on a 15-minute time frame. So first, we see that the price is trading above the 20 and the 50 EMA. And the 20 EMA is above the 50 EMA. The slope of both of the moving averages is also sloped upwards. So we are looking at buying setups only. Now we wait for a pullback. Here we see that the price has successfully made a pullback. The pullback touches the 20 EMA and it does not break below the 50 EMA. Hence, the trend is still intact and the pullback is valid. So now, we wait for the price to break the most recent swing high. Here is the most recent swing high. So we extend a line from this swing point and wait for a breakout. The breakout happens on this candle. Therefore, the price has successfully broken above the recent swing high. We will enter a long position on the close of this candle. We can place our stop loss below the 20 EMA, and we can place our targets at 1.5:1 risk to reward ratio. And as you can see, we achieved our profits on this trade. Now, let's look at a sell trade and understand the rules of going short. To sell, we first need to make sure that we are in a downtrend. So, we first look at the moving averages. For a selling opportunity, we want the 20 EMA to be below the 50 EMA. The price should be below both the moving averages and the moving averages should be sloped downwards. All of these conditions are met on this chart. Hence, this is a valid downtrend. Now, we wait for the price to pull back to the 20 EMA. Here is the pullback. We can clearly see that the wick of this candle touches the 20 EMA, and the price does not cross above the 50 EMA. Therefore, the pullback is also valid. Now we wait for the price to break the most recent swing low. So we stretch a line and wait for a breakout. Notice here that the price touched the 50 EMA while we were waiting for the breakout. This candle barely touched the 50 EMA and reversed. Had this candle closed above the EMA, the trade would have been invalidated. But since it didn't, the downtrend was still intact. So we enter on this candle as the price breaks below the recent swing low. We keep our stop loss above the 20 EMA and place our targets at 1.5:1 risk to reward ratio. As you can see, we made profits on this trade as well. Now, I am not saying that this strategy works all the time. Just like any other strategy, this strategy will also have losing trades. I am just sharing this strategy so that you can test it for yourself and try it. That brings us to the end of this video. Be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.